Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin. Here we are. We are back. Episode 9? Feels like we've been doing this for a long time, right?
Gosh, we must have been. I don't think we could be doing this more than 8 weeks.
Sometimes I listen back to our episodes and I'm like, is this boring? Are we a little dull? And then I realize
you are a little dull. I'll answer for the others.
I'm definitely a little dull, and maybe we can bring a little more energy into this. But I'm specifically trying to reach people who want to learn. So if they tune in for a few minutes and realize that we're talking about things that they probably aren't going to stumble upon themselves, and that piques their interest, and they actually turn their brains on and tune in and pay attention and learn something, that's who I want to be reaching anyways. So while we can try to bring a little more energy, I'm not going to change who I am just for the clicks.
I'll tell you the general nature, the overlapping Venn diagrams, the circles, what's in the middle of who likes the economic strategy that we're talking about. They're going to have a few common denominators. They're going to have a sense of economic or otherwise rugged independence. They're going to have to be in tuned to the long range, or what aids that a lot is to the spiritual, or the I want to do something for myself and my progeny, my children and grandchildren, etc. I want to create something lasting, and a little bit of screw you experts, just because we've been programmed our whole lives to do things in a certain way.
Sure.
Go get your bank account, put all your money into it. That's where to put your money, or the economic patterns of if I give up one latte a week, I can have leather seats. Do I realize that I'm committing to an extra $800 of interest? No, but it's the poison of the economic thinking that if we can push back on that, or find the people who kind of want to break free and take that red pill, then you've got a good format or foundation for somebody who would like to listen to you or me, no matter how boring I might be, or how marvelous, handsome, and interesting you might be.
Why, thank you. Before we hit record, you used the word sovereign. I resonated with that, because what we're doing is it's taking control of our finances in a much more direct way, and really divorcing ourselves in some way from the commercial banking system, from Wall Street, from the IRS, as best as we can.
Yep, or from the conventional wisdom in general. So take those things. Wall Street, you want to divorce from risk. Now, everybody wants reward, but if you can delay that reward, we've talked about the marshmallow, the Stanford marshmallow experiment, right?
Right.
Some people I know, if you give them, you offer them one mushroom, and you tell them if you wait until later you can have 2 mushrooms, they'd go for that. And both the foodies and the other people. But we're talking about marshmallows. If you can delay gratification, you can have a lot more. So divorcing from the risk of the market, you mentioned taxes and the IRS. Well, there are ways of avoiding legally taxes forever. So if somebody is pretty cool with the threat of the income tax when the debt hits 60 trillion, then okay, be cool with that. We kind of want to talk to people that aren't cool with that.
We're definitely trying to reach a specific kind of audience, people who know that there may be a better way of doing things than the conventional experts say is the only way to do things.
Another point to that is discipline has to sort of be in that little pot too, that little cholent for some of our users, the stew of all these ingredients of the personal traits that would make someone be interested in this. But the discipline means I made a short on the Real Change Financial channel about Florida's chance to end property taxes, whether it's staggered or they build up to completely eliminating that. And if you're the type of person that could say, wow, for my 10 years in this house, thank God this big house has become small with lots of kids. Well, I've been paying property taxes, started at about 7,000, now it's up to 9,000. But every year I've paid it come hell or high water. What happens if they end it? Well, we want people to have the discipline of, like I mentioned in that short, don't stop paying your property taxes. Just stop paying them to your county. Pay them to yourself. If you get into an economic pattern, a financial or a budgeting pattern, take advantage of that. Make that your superpower and give us the people, hey, people that have this tendency, listen, use that discipline to magnify tenfold your wealth at the end of, during and especially at the end of your life. And at the end of it, if you want to avoid all taxes, estate and anything, in transferring that over because you enjoy the thought of longevity, then stick around. There might be something interesting here.
And we're always referencing this book, Penny, Becoming Your Own Banker by R. Nelson Nash. Why is it that we're always referencing? You have one too? Why are we always referencing this book? And why do some people think that there's nothing worth looking at there? I know it's a tough question. We didn't have that one planned.
Two sides to every coin, right? I love it or I hate it. Yeah, sometimes it's well. First, anything new is difficult. It's not my expression. It happens to be a very old saying. All beginnings are difficult. So, to relearn your thinking, your financial thinking, it takes an effort. But once you do it, hey, somebody mentioned. I'm just kidding. Dovi mentioned earlier. You take a book like Nelson Nash, you read it through once, get through it. Take a break, then read it through again, but with a critical eye, and start asking questions. Challenge the assumptions in the book, and figure out, well, is the world really crazy for thinking that 2% interest is not the healthy interest rate forever and ever? Was there something that our nation gave up to achieve those interest rates? And start challenging anything in the book. Well, do I really have a greater need for finance in my life than for life insurance? Is banking really the problem? If you can't come to a yes there, you might not be for you.
Right. I did want to read a small passage out of this book. So this is on the first page. It's actually page 3. And Nelson says very clearly, this book is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments. It's not about rates of return. As time goes by, interest rates are up and interest rates are down, but the process of banking goes on no matter what is happening. And so this book is about how one finances the things of life. It's not about investing. This book is not going to teach investing. This book is going to teach about a mindset shift of how you can create a pool of capital in which you have more control here than anywhere else, and you can use that capital as a private banking system. That's the idea. So what is the banking function, and why should I want to control it?
Well, what do you do with your paycheck every week, right? You put it somewhere.
Correct.
And what do you do when expenses come up? You access your money. What if a big expense comes up? You access your savings or liquidate an investment. So, banking, like it or not, takes place. So there really is no way around it. Your money has to go somewhere. It's got to go to some some
Yeah.
pool, even if it's the pool in my pocket that's reserved for buying things cash that I don't want to put in the credit card, not because I don't want to buy them, but so that my wife won't necessarily know that I bought the chocolate bar.
The strategy of becoming your own banker, it's the solution to a very important problem. It's a problem that everybody faces, whether we think about it or not. And that is that we finance everything in life. Everything is financed. We either borrow from somebody and pay interest to them, and borrowing is always a worse deal than it looks on paper. Or we pay cash, which is definitely better than borrowing, but it has its own problem. And that problem is that you give up the ability to earn interest on that money forever. So you're either borrowing and paying interest, or you're paying cash and giving up the ability to earn interest.
If you understand that a bank is an incredibly profitable business, and there are some banks, I know there was a book published called The Secret Banks. I cannot find it in print anymore, but it predated becoming your own banker by a long time. It was talking about the capital that life insurance companies sit on being the real foundation of our economic system. How so? Well, you've heard of the phrase, or maybe you haven't, when the Fed closes the lending window. When the Federal Reserve says we're not going to lend any more money to banks or let them write debt and sell it to their consumers anymore, right? We talked about that when I got a mortgage for 300 grand for the home I'm in, they didn't take 300 grand out of a vault and give it to me to give right to the seller of the home. They created $300,000 in debt for me and credited the seller with $300,000 they sent to him that he went and deposited to his own bank. And now I'm paying interest for 30 years on that debt to the tune of about 40% more than that, so 100,000 plus in interest easily. Now, banking is profitable. You want to get there. And it's so profitable that the big stumbling block in people's thinking is, I have to borrow even from my own bank. Don't worry, the profits of your bank far exceed the cost of access to your money when you do this the right way. Banking is so desirable to get into that, Nelson Nash jokes about the how hard it is and the fiery hoops to jump through to actually do it. But if you really understood the profits a bank makes, you'd want it for yourself. And when you realize you can replicate that with this 200-year-old product, you'd want to do it. You'd want to become your own banker. Therefore, it's almost like having to understand that better. Go ahead and ask a successful small business owner, are you in the stock market? No, I make more money in my business. They would salivate over how profitable a banking business is, and they would run all of their profits into their own business were they bankers. This is almost a harder intellectual leap to understand how good it could be when you have this set up.
Yeah, give a quick example of how a business owner would set up a policy and use it to finance the things for their own business.
So say somebody with a recurring expense, like a printer who has $100,000 a year expense on paper. So instead of taking last year's profits, paying your taxes, and then buying paper, Infinite Banking would say, let's take that 100 grand, put it into my bank, my whole life policy designed for high early liquidity, put in my 100,000, borrow it against my bank, because my bank just got a great new customer called me. And every year I'm paying the profit into the bank, my bank, and borrowing my costs for paper. And 10 years down the line, here's where you have to really stay with it and pay attention. 10 years down the line, you've now spent $1 million on paper, ergo you've borrowed $1 million from your bank. What have you paid back? Have you had to pay back that $1 million? There are two paths here now. I've got $1 million loan. A couple ways to deal with it. One is, I know I have a succession plan and I'm going to sell my business. Therefore, with that windfall of profit, I can pay back this loan. The other way to think of it is, with my $1 million loan to self for paper, well, I've got a $10 million death benefit. If I wanted to, I could wait forever and let the death benefit pay off that loan, forever meaning until the day I die. So if it's designed the right way, you should always have the ability for the death benefit to cover your loans. Now, the middle path might be treat it like any other bank. If you were going to finance your need to buy paper from the Bank of America, you would pay the Bank of America back that loan. So there's a medium in between those extremes, which might be routinely, in a deliberate, measured way, paying back some or all of that loan as your business grows, for instance. What you're left with in the end.
An important thing to realize here is that when you pay off a policy loan, all of that money, aside from the interest cost, which we can get into another time, all of those repayments, they become liquid again. It's not like a typical bank loan where you pay off your loan and that money's gone, you just gave it to the bank. You're repaying your policy loan, which creates more available cash inside of the policy for you to use again.
Very good. Think of it like, and this is why in the case for IBC, the authors liken it to a line of credit, where when you pay back your loan, the line of credit is replenished. The difference is you own this credit and it's growing every year at a guaranteed rate, tax-free. So no matter what you do, your line of credit, your gross line of credit is growing every year, and your net line of credit, once you've paid that loan back, is reaching that gross limit. So, very good point. It's just because the word loan is tainted. You said very, very interestingly, one of the previous episodes, that Nelson Nash faced bankruptcy. Dave Ramsey went bankrupt, and they came out of the experience with galvanized in different ways. One said, if I own the loan, Nelson Nash, if I own the bank and I originate the loan to myself and I pay it back, great things can happen because I'm a banker. One said, avoid debt at all costs, Dave Ramsey.
If we can condense becoming your own banker in a nutshell, it is build uninterrupted compound interest and have ultimate control over that pool of capital.
If you had to really condense it, you'd condense it into the MOMSECTAN. What is that? I mean, that's an acronym, of course. It is a worthless acronym for money multiplying, self-completing, tax-avoiding ninja.
It's a worthless acronym until we start putting on hats, t-shirts, and mugs.
There are year-to-year returns that are greater than 100% for a mature bank. Easily.
100%. Yeah, you put in $10,000 a year, and inside of that policy for that year, the cash grows by $25,000. It might take 20 or
it's all
20 or so years.
So it's tax avoiding forever. Your capital and your access to it, and the death benefits. Our senior partner, he's talked about it in other venues. His mother-in-law, may she rest in peace, had a lot of money on the Upper East Side, and they haven't seen a dime yet. It's been 2 years since she passed away. When something's not structured the right, but what does this goes to show you? That you can have a great effect, you can evangelize, so to speak, you can get someone to hear the message, but oftentimes not family, because they don't want to listen to you. but
Right.
died very wealthy, and her two daughters haven't seen a penny yet because it's wrapped up in courts. Tax avoiding while it's accumulating as your equity, your capital, and you're accessing it with the loan feature. And of course, estate tax avoiding when it transfers, so bittersweetly, transfers so fast and tax-free to the beneficiaries. And then self-completing, meaning you've got a goal of saving $1 million over your lifetime for your family and for your retirement. Well, what if? Life's what ifs. What if someone passes away early or becomes disabled and can't earn a living and contribute anymore? Well, life insurance solves for all of these things by self-completing. And that envisioned fortune is exactly what your death benefit should be, transferring to your family's domain. The momsectan aside, again, just being silly to say, how do you present all this information in one palatable explanation that doesn't take a 40-minute podcast to break the ice and talk about the basics? Well,
Right.
really,
We really just covered some of the basics. It gets a lot deeper than this.
for sure. Stuff that we've also released and talked about: creditor protection, non-market correlation, other. Lots of people have racked and stacked all of the advantages and features of this. For the Go Bank Yourself audience, we just want people to know that it might be hard to make this flashy, like the marshmallow experiment I brought up before. If you can wait the equivalent of those 15 minutes, if you could wait 15 years.
With that said, with the whole waiting 15 years, you can still tap into a large portion of the cash you put in immediately. People who set up policies are typically anywhere between 60 and 90% liquid on day one. So while it might take a few years to get to a point where you're cash on cash positive, money that you put in that year grows by equal or more than that in that year, will take a few years. It'll take a few more years to completely break even on the cash that you put into the cash you have available in cash value. But from there, you are off to the races. Like, why would the first few years stop you when you could be living another 70, 80, 90 years?
Yeah, well, only because Dave Ramsey tells you it's horrible and it doesn't give you the sugar right away. If that first year is not more than what you put in, then it must be a bad investment. And your brain is just programmed to receive the message of, get me the most, the fastest.
There was a call where Dave was bashing on Whole Life, and he was like, well, somebody sits you down and shows you how you're going to have all this money in 40 years. Well, that's in 40 years. What about right now? You have no money now. You have no money for the next 40 years. And this is probably before I really understood how whole life policies work. Thinking about it, that's literally the opposite. His way is you won't have any money now, but you'll have a lot of money in 40 years. Our way is you're building up this pool for the next 40 or however many years, but you can use it in the meantime, and as long as you manage it correctly, you're going to have way more benefits than just throwing something in an account and never touching it. Because here you will get that uninterrupted compound growth. In 40 years, you'll have a ton of money, and you've been able to use it again and again and again.
Yep. For the Go Bank Yourself audience, everyone loves a good pilot flight officer joke. So let's just start that off. I'm being facetious. We've never brought this up yet, but
let's do it.
Why do I want to say this? Because when you have your stock portfolio, your mutual funds, you're just going like this. You're watching how it's tracking. It's up, I'm happy. It's down, I'm sad. It's up again, I'm happy. Go to your church or synagogue and see what they're talking about when they're not focusing on the one above. It's probably something financial. What are the markets doing and why? So the joke is, about following. A pilot has a goldfish, and when he traces his finger along the aquarium wall, the goldfish is doing loops. The goldfish is doing whatever his finger does. He goes up, the goldfish swims up. Goes down and does a little a loop. The fish does a loop. He twists his hand, the fish does a barrel roll. It's amazing. So you have, the background is that pilots and naval flight officers, like I was, there's a little bit of a jousting going on there. So the pilot says, the other day I walked into my living room, and my flight officer, my navigator was at the fishbowl, and the fish was going like this, and the navigator was going like this, meaning the fish was in control. All right, fine. I don't have any regrets about what I did in the Navy for 9 years. The point is, you're just watching the market. Are your investments really what you're living off? Are you banking and financing your life with those? Of course not. In fact, when it's up and you're so happy, you wish you bought more, and you don't want to touch it. When it's down, you're sad that it's down, and your advisor is telling you, go buy more and go buy the dip. But are you financing with that? You're building for an eventuality that you hope after taxes is going to be large. Now go back to the
Right.
self-completion.
In some ways you can bank with it, but it brings in all sorts of unnecessary risk.
Yeah.
Nelson even says in Becoming Your Own Banker, you can bank with anything, any marketable product that has real value. You can bank with anything. But we specifically use these policies because it's the most efficient way to use this process.
Yep. And it's nothing new. It's not the new hotness in investing or even in savings. It's something that's been around for 2 centuries, and it's already tried and true. It's just up to us to try it and find the truth in it.
Penny, it's great to see you. Everybody, if you made it this far, shkayach, give us a like, comment, subscribe. Let's up those numbers. I think as we speak, we're at 61 subscribers, so that's up from the 55 that we were sitting at for a few days last week, and 50 that we were at for a few days.
Orders of magnitude.
A few days before that. Orders of magnitude. Hey, we've been up on YouTube for not even a month now, and we're at 61. So thank you everyone who has subscribed, who's been tuning in. Keep on tuning in. We're doing our best to fine-tune this thing, make it as palatable and easy to understand as possible. Ideally, we break this down so simple that you can teach it to a 5th grader.
Exactly. Thanks, everybody.
Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.